Did you know that one simple investment could make you a millionaire without picking individual stocks? Well, let me show how index funds can turn market growth into a wealth building machine. In this video we talk about how to build wealth with index funds and the things you have to consider, how index funds work, what they are, and everything you need to know about index funds to start investing in them. So basically, index fund is a fund you can invest in with low costs, and you can cost effectively diversify in equity markets globally. So what makes index funds such a great option to invest in is that it's super easy to get started with them. You don't have to have a lot of money to do that. They are passively managed, meaning there is no active portfolio managers making decisions where to invest your money. Let's quickly talk about how index funds are different compared to, for example, mutual funds or ETFs. So index funds are passively managed funds that track a specific market index, for example, S&P 500. Index funds are ideal for long-term growth, especially for those investors who just would like to invest their money but are not interested in making a lot of research. Then ETFs are similar to index funds, however, they are traded on stock exchange like individual stocks, and their prices fluctuate throughout the day. And then we have mutual funds. Usually mutual funds are actively managed funds, and actively managed funds aim to beat the market, and that's the reason why they have higher fees usually. And that's the only downside of them really, because when you invest in index funds, they are cost effective, like I told you, low costs, easy to invest in. Especially when thinking this from long-term perspective, it's really important that you know what kind of fees your investments have. So if you're only investing in actively managed mutual funds, those fees can add up a lot over time, and they will eat into your returns. Shortly, index funds are ideal for passive, consistent investments over long term. Why you should consider investing in index funds? Well, first off is obviously diversification. If you're not diversifying your investments, it can be hard to make good returns, but also you're having much higher risk of losing your money. So that's why index funds are a powerful tool for building wealth and start investing. And I have made a video about how to start investing in index funds. And if you're interested in more specific details, make sure to watch it. I'll leave the link down in the description. By investing in an index fund, you align your portfolio with the long-term growth of the market, which allows you to avoid unpredictability of individual stock picking, because you don't know how the stock is going to behave. But when you invest in a well-diversified index fund, it's much easier to make consistent growth long-term. The next reason why you should invest in index funds, like I told you, is low costs. And like I told you, the expense ratios and fees are significantly lower than in actively managed funds. The next thing is simple and stress-free investing. What makes index funds so great is that you can eliminate all stock research you have to do and basically all individual stocks. When you invest in an index fund that mirrors a market index, you save more time and avoid stress of more riskier investment options. The biggest advantage in investing in index funds is the power of compound growth. And obviously, the more you invest every month in index funds, the more compound growth you can get over time. So the main point here is that index funds are ideal for leveraging the power of compounding. So that's something I want you to remember from this video. Benefits of index funds: low costs and low fees, great diversification, you don't have to do any stock research, you don't have to pick individual stocks, and obviously long-term performance. If you don't know where to invest, start with index funds. It's such an easy way to put your money to work for you. You get long-term growth from there. And when you invest in index funds, like I told you, they mirror the market indexes. Well, you won't be able to beat the market like you would with individual stock picking. But like I told you, when picking individual stocks, it's more risky. And by picking individual stocks, you're not able to decrease your risk. Or let's better say, it's harder to diversify your portfolio in a good way. So now let's talk about how index funds work. So like I told you, index funds follow a certain market index. So for example, S&P 500, which is probably the most known index among investors. So basically how this works is that the fund invests in the same stocks as the index it tracks. So basically the fund is mirroring the performance of the index. The goal of that fund is to match market's returns. This passive strategy makes investing in index funds an efficient investment option. Then there's another term related to index funds which is very important, called net asset value. So net asset value in index funds represents the per share value of the fund's assets minus its liabilities, and it's calculated at the end of each trading day. Net asset value determines the price at which investors can buy or sell the shares of the fund. And remember that net asset value changes daily based on the market value of funds holdings. Then let's talk about risk and limitations of index funds. So when we compare, for example, market volatility to index funds, one thing you really notice is that, for example, the less stocks you own or the more volatile stocks you own, the higher risk you have. in your portfolio. But if you're investing wisely, you have some money in individual stocks, you have some money in index funds, maybe you invest a bit in crypto or mutual funds, ETFs. Having great diversification is key for reducing the risk of losing your money. Obviously, one limitation of index fund is that you can't beat the market. If you want to beat the market and be an effective and active investor, picking individual stocks can be your way to invest. But definitely make sure you do the research and know how the stocks behave, and most importantly, know where you're investing in. Because when you're picking individual stocks, there's much higher risk. But obviously the good thing is, even if you fail at something or you lose your money, the best way to learn is to learn from your own mistakes. When we talk about investing, the most important thing is never invest the money you're not ready to lose. Let's talk about building wealth with index funds. First thing I want to touch on is the compound interest and compound growth. So let's take a concrete example here. So let's say you started investing $500 every month in index funds, and on average you get 8% annual return on your investments. So you invest $500 every month into cost-effective index funds for the next 25 years. After 25 years of cost-effective and long-term consistent investing, you will end up with a total balance of $479,183.29. And imagine how incredible that is. You're investing $500 every month, which basically means that you're investing $6,000 a year. But again, important thing here is that you're investing monthly, so you're reducing your risk in a way that you're buying during good times and bad times. As you can see, by investing monthly and just being consistent with that, that's enough to grow a crazy amount of the invested money of your own, and then obviously getting the compound interest. And of course, the longer you'll be able to do that, the higher the total interest will be. The next important thing about building wealth when talking about index funds is that set long-term financial goals. So when investing in index funds, don't aim for some crazy returns in a couple of years or 5 years. It's not going to happen. By setting long-term financial goals, you'll be able to, stay consistent and act according to your plan. So if you, for example, planned to invest, let's say $200 every month in index funds, stick to that and do that every month. And let's say you get a chance to invest a bit more and you actually bump it up to $400 a month. And if you're able to do that, go ahead, because you're able to invest more money. And even when the market goes down and you see that some of your investments are not performing well, keep investing, because when you're investing in index funds, I assume your investment horizon is quite long. And when the market goes down a bit, that's not a sign of that you should stop your contributions. Go ahead and invest in there, because when the market drops a bit, you're able to buy it lower, and when the market goes up again, you'll be very happy with those investments because they can actually give you bigger returns. Then, last but not least, let's quickly talk about common investing mistakes to avoid when investing in index funds. First off is over diversification. The mistake here is that if you're investing in too many index funds, and especially index funds that are similar to each other, you're not able to diversify your risk anymore. So if you diversify too much, the problem here is that you're not able to see the impact of high-performing assets, limiting potential returns. And then second thing is timing the market. Timing the market is basically impossible. You can't really predict when the prices start going down or up. So if your investment horizon is long, there's no need to time the market. You won't benefit of that in any way. It's much better decision to stick to your plan and stay consistent with your investments over time. That's how you get the best result, like we discussed before in this video. So eventually, building wealth with index funds aligns with principles of simplicity, cost efficiency, and long-term growth. And that being said, that's it for this video. I hope this was helpful and you got motivated about starting investing in index funds, because it really is easy to start. You don't have to have a lot of money to do that. You can start with $10. Start it today, because the earlier you start, the better. If you're interested in more financial videos, I would highly suggest to watch this video next. It is about 10 financial terms everyone should know. And if you're new to the channel, click here to subscribe. Thank you guys so much for watching, and I'll see you in the next one.